Did your parents ever read you fables when you were a child? Those simple stories that often seemed far-fetched but always carried a deeper lesson? Fables have a way of making complex ideas easier to understand, and in many ways, trading is full of fables of its own. Stories of traders who took risks, faced setbacks, and learned important lessons the hard way. Let me share one with you about an imaginary trader named Alex. Alex was a young and ambitious trader who had recently started trading the stock market with a capital of 25 lakh rupees. Like many new traders, he was eager to make big returns as quickly as possible. He read books, followed market trends, and spent hours analyzing charts. But there was one thing Alex believed more than anything else. If you want to make money fast, you have to trade aggressively. He didn't want to play it safe. He wanted to grow his capital quickly. One day, Alex became particularly interested in an imaginary company called Shakti Motors Limited, a well-known auto manufacturer. He had been closely watching its stock price for months, and he noticed a pattern. The stock had been trading in the range of 1500 to 1530 for the past 6 months, with its 52-week low at 1490. He had also observed that every time the company announced the launch of a new vehicle, the stock price would jump by at least 50 rupees. Alex saw this as an opportunity. The company had a big launch event coming up for its latest electric vehicle. Alex was confident that history would repeat itself. The stock price would rise following the announcement, and he could cash out with a quick profit. With this plan in mind, he bought 1,000 shares at 1520 rupees, expecting to sell them at around 1,570 rupees once the news broke. In his mind, this was a sure shot. How could it go wrong? The maximum risk, he thought, was the stock falling to its recent low of 1490, which meant he would only lose 30,000 rupees at worst. But the markets have a way of humbling even the most confident traders. Things didn't go as planned. Alex believed he had placed a stop-loss order to limit his losses, but due to a technical glitch in his trading platform, the stop-loss order never got executed. That was the first problem. The second problem? Just a day before the launch event, the managing director of Shakti Motors was arrested for financial fraud. The news spread like wildfire. To make matters worse, the company suddenly announced that due to supply chain issues, the electric vehicle launch would be delayed indefinitely. As if that wasn't enough, that same week, the Reserve Bank of India hiked interest rates unexpectedly, causing panic among investors. The markets started falling, and Shakti Motors stock wasn't spared. The price plummeted from 1520 rupees to 1400 in a single day. Alex had not set a manual stop-loss in time, and by the time he realized what was happening, he was looking at a 1,20,000 rupees loss, much more than he had ever prepared for. Now, what could Alex do? He had two choices. He could either sit in despair, beating himself up for not accounting for every possible risk, or he could accept the reality, learn from it, and move forward. The first lesson here is that no matter how much preparation we do, there will always be things outside of our control. Alex had analyzed past price movements, studied patterns, and made what he thought was a smart trade. But the market doesn't care about predictions. There are always unknown variables: unexpected arrests, company delays, interest rate changes, global events that can shake up even the best-laid plans. What seems like a great idea when entering a trade can often look like a terrible mistake in hindsight. But this is where successful traders set themselves apart. They don't dwell on what they could have done differently. Instead, they focus on what they can do next. The second lesson is about being prepared for the worst. While it's not practical to obsess over every single thing that can go wrong, it is important to be mentally and financially prepared for setbacks. Alex had only considered the best-case scenario. He assumed that the maximum he could lose was 30,000 rupees, but he hadn't planned for an extreme situation where he could lose much more. Experienced traders know that anything can happen in the markets, and the best way to protect themselves is to have risk management strategies in place. If Alex had followed proper risk management, he might have diversified his capital instead of putting too much into one trade. He might have ensured that his stop-loss order was actually executed before walking away from his screen. And most importantly, he would have been psychologically prepared to take a hit and move on. Disasters happen, but they only become truly disastrous if we let them define us. If Alex allows this one trade to destroy his confidence, he might hesitate the next time he sees a good opportunity. He might start trading out of fear, trying to recover his losses quickly, which often leads to even bigger mistakes. Or worse, he might give up on trading altogether. But successful traders expect setbacks. They accept losses as part of the game and focus on the bigger picture. The right move for Alex now is not to sit around regretting his decision, but to analyze what went wrong, adjust his strategy, and move forward. Instead of trying to make back all his losses in one risky trade, he should slow down, trade smaller sizes, and regain his confidence gradually. He might also reevaluate his risk tolerance and set more realistic goals. That brings us to the third important lesson: setting realistic expectations. Many new traders like Alex get into the markets expecting quick and consistent profits. They hear stories of people doubling their money and assume that they can do the same. But real trading doesn't work that way. Success in trading is about long-term consistency, not short-term wins. Alex's approach of trying to aggressively grow his 25 lakh account might not have been the best strategy for a beginner. A more patient approach, focusing on small, steady gains rather than big, risky bets, could have served him better. At the end of the day, the market is unpredictable. No trader, no matter how experienced, can control everything. There will always be chaos, uncertainty, and unforeseen challenges. The difference between winning traders and losing traders isn't that winners never face setbacks. It's that they recover faster. They accept losses as part of the game, learn from their mistakes, and keep moving forward. Alex's story is one that many traders can relate to. If he chooses to let this loss define him, he might never trade with confidence again. But if he takes it as a learning experience, adjusts his approach, and keeps working on his skills, he has every chance of coming back stronger. That's what separates those who succeed in trading from those who don't. The market rewards those who stay in the game, and the only way to do that is by adapting, learning, and always moving forward.